We're here to present results for FY21, the year ended 30, which we released a couple of. Here I am with Beth, our designer, put me next to a beer machine. I'm not quite sure the point there, but I thought it was it's certainly a let's start with who we are. Now, many of you know us already. I can see that we do have quite a few shareholders on the line. What we do have on the investor section of our website, Capital Markets Day video that we did in the year. It's a real deep dive into the strategy of the business and the history of the business, plus also a tour of our showroom. Director Jenny Stewart. We are a branded consumer goods business, supplying products for the home through retail and online channels. We are very much mass market and value led, typically just above own label in terms of price points, and we have 5 major product appliances like kitchen electrical, housewares, so for example audio, laundry, and we employ over 300 people across the group, and we have offices in Guangzhou in China, Cologne in Germany, and we're headquartered in Oldham in Greater Manchester. 300 retailers across 38 countries worldwide. We source from 16 countries, although the bulk is from China. And we have a really important and well-established talent development process. We are primarily a product business, but product requires talent, and we have a talent process centered around our graduate development scheme, which has been very, very effective and in fact transformative over recent years. At the bottom there, you can see some of our brands. Our 2 largest brands are Salter and Beldray. We have 1 licensed brand, which is about 10% of revenue, in Russell Hobbs, where we do the cookware, not the electrical. That's what they do. And then we have some up and coming brands. Progress, which is sort of Lancastrian bakeware brands dating back 90 years. We have Clean Easy, which I think many know from the catalogues, which is 100 years old next year. And then we have our recently acquired Petra brands, which is a German coffee brand originally, but which has been taken into other areas of kitchen electrical, and that's in the process of being relaunched for our German and wider international markets. So, quick summary as to our FY21 numbers, where revenue was up nearly 18% to 136 million. Underlying EBITDA increased 28.3% to 13.3 million, up from 10.4. Really pleasingly, our EBITDA to 9.7%, up from 9% the year before, against the background of quite in the second half of that year. Underlying PBT increased 36% to 11.2 million. And then quite close to the end of the year, mid-July, we completed the acquisition of Salter. Salter was previously, we've been selling under the Salter brand for about a decade for kitchen electrical and cookware. And we licensed that brand from the Scales business that people know very well. In July, we acquired the brands as a whole, including that Scales business, for nearly 34 million. As a result of that did push up our net debt. We were virtually debt free just ahead of that acquisition. The acquisition was part funded by debt, but as well as an equity raise. And as a result of that, our net bank debt at the year end was 18.9 million, up from 3.8 million at the end of FY20. and that equates to an EBITDA ratio of 1.4 times as a result of that acquisition. Although we do expect to see that reduce back down to about 1 times as we go through this current financial year. Plenty of headroom within our facilities, 16.2 million, and also within our banking covenants. So we're a business. EPS increased 34% share, and we increased our dividend per share by 26.9%. The Salter acquisition is now fully integrated, and we expect it to be significantly earnings enhancing in FY22. Bit of history, as I say, we do have the capital video, but you can see there the history from when Simon, our CEO, founded the business in '97, all the way through to now. And what really jumps out for me is the acquisition of brands as we've gone through the years of that journey. Financial review. Graham, our CFO. I'm going to do as good a job as him. We'll see how well I do. But you know, I've covered off most of the headlines already in terms of improvements in revenue and profitability. One thing I would point out on this slide is that we don't many adjusting items in order to get back to, you know, from reported profitability to underlying. We typically, it's just the non-cash share-based payments charge. There is in 2020 and 21 the effect of the repayment of the furlough. So we had that as we received furlough money in FY20 and repaid it in FY21. So we've treated that as an adjusting item in both those years. And also we had acquisition costs which were expensed relating to the acquisition of Salter of £1 million. Profit bridge, as you can see, pretty straightforward in many respects. We go to the left-hand side, you know, increase in revenue leading to an increase in profitability. But in the second half of the year, we did see significant pressure arising from increased shipping costs, which I know most of you will have read about. And I will go into this in a bit more detail later on in the presentation. So 2.5 million of additional freight costs. About half of that 1.4 million we were able to mitigate in various ways. And again, I'll go into a bit more detail on that later in the slides. So in simple terms, increase in revenue plus some challenges around freight on the margin. And that's why, as I said before, we were really quite pleased at being able to increase our operating margin from 9% to 9.7% despite some of these underlying cost pressures. Breakdown of revenue by the various categories. You can see here by territory, you know, strong growth across the board, really, with the exception of rest of Europe. What was really pleasing for me was to see Germany, which has been an area of particular focus, continuing to perform well and grow very well in that year. You know, despite saw quite a lot of retail closures as a result of lockdowns. Rest of Europe, there's quite a few discount retailers in that category, and what we saw with discount retail in Europe was they were much more likely to be closed during the year, and that of course had a knock-on effect in terms of their ordering from us. You see down the bottom we have 4 strategic pillars: discount, supermarket, online, in addition to international. And again, the growth was pretty broad-based. You know, supermarkets in recent years, you can see there over the 3 years, they're from 20 million to 37 million. There's been a real sort of rapid grower. And we do see supermarkets, increasing as a share of revenue as we go forward. When we IPO'd in 2017, supermarkets were 14% of revenue, and I think this year they were 27%. So it is increasing as overall as a share of our turnover. Online, a great performance there, up 23%. But actually, it was a year of two halves. First half of the year we were up 50%, and second half we were down slightly, actually down 2%, and that was all down to stock availability. As the shipping crisis took hold and availability of shipping tightened, we had to prioritize, and what we did is we prioritized our retail customers. We'd made commitments to them to deliver products, and we felt it was the right thing to do to prioritize our shipping towards them. And as a result of that, there was less stock available for online, and therefore it was broadly flat in the second half. We do see that having an effect in the first half of FY22, but as stock returns to the business, and we are seeing some good signs that that's happening now, we will see online return to the kind of rapid levels of growth that we've seen to date. And just to put into context, online, when we IPO'd in 2017, was less than 5% of revenue. Despite the slowdown in the second half of FY21, it was still 15% of revenue, and we do see it going to 30% of revenue in the medium term. So moving on to our brands, again, pretty broad based. Growth across the board, really. Really pleasing to see the likes of the growth in the likes of sort of Progress and Clean Easy. There are up and coming brands, but also strong growth in those top brands like Beldray and Salter. And those brands, which we consider to be our premier brands, you can see at the bottom there, their share of our revenue has continued to grow from just over 60% in FY19 to over 75% in FY21, and we do see that trend continuing, with the business being increasingly focused on the brands that you see on that list. Just with regard to Salter, obviously with the acquisition taking place right at the end of the year, the contribution to revenue was minimal. It won't be till FY22 that we see the Salter Scales business contributing meaningfully to overall revenue. And then finally, in terms of the revenue analysis, a breakdown of by product area. Again, pretty broad based, with the exception of audio, and I'll cover this in more detail later on. But we fundamentally we supply large products for the home, and the home has and we believe will continue to play a big part in the consumer economy over the next few years. Audio was tough because a lot of our customers for audio were directly affected by store closures, particularly some of our European retailers. Now, Graham always says that he kind of mourns the increased complexity in his balance sheet. He always used to boast about how simple our balance sheet was pre-IFRS 16, and of course before the Salter acquisition. So you can see there now, with Salter, we've got some intangibles and goodwill. But I think nonetheless, when you look beyond that, it is fundamentally a relatively straightforward balance sheet. We're a capital-light business because we outsource our manufacturing. So we have a modest level of fixed assets when you look beyond the IFRS 16 balances. And we have working capital to fund the stock and our trade debtors with our retailers, and then we typically have bank debts to fund those working capital balances. So, you know, it is still, I think, just about we can say it's relatively simple, and I do think it's also a conservative balance sheet. You know, we are a management team that believes in sort of, you know, financial conservatism, and we do believe in carefully managing our balance sheets in a cautious and conservative way. So cash flow, I guess the main headline here is that acquisition of the Salter brands, 30.6 million. We do have some balances to pay during FY22, and the rest of the cash flow is relatively straightforward. We do in understanding our operating cash flow. The way I think about, you know, it can fluctuate year on year because our working capital balances can fluctuate year on year. But when you look through on the medium term, we are cash generative. We do de-gear over the medium term, which is what happened in the run up to the Salter acquisition, and that's because we retain half of our profits in the business. We distribute the rest as a dividend. But fundamentally, because we're capital light, once short-term fluctuations working capital are ironed out, that retained cash flows down into a meaningful reduction in debt, and that's something, for example, you can see particularly in FY20 there on the cash flow there. Okay, strategy and outlook. As I mentioned before, we have 4 pillars to our strategy. Those who know us well will have heard this many times before. International. Now the logic here is that we bring product to market, historically for the UK market, but actually our products are products that you see on countertops in kitchens and all over the world. And so so we do spend a lot of time developing products, and then in the past we've generally just sold it in this sort of small island off the northwest coast of Europe. So this is about leveraging that product development across multiple territories, and getting the operational leverage from that, but also obviously generating new sources of revenue. Our focus is on Western Europe. It's nearest to us and culturally quite attuned. And also it's a big market, and within that market, our primary focus is Germany. Germany being the largest consumer market in Europe, followed by the UK, followed by France, but also a market that we felt and continue very much to see that our brands and our product offer definitely resonates with that consumer. Secondly, supermarkets. We were always when we IPO'd, we were underweight on supermarkets, and supermarkets have been challenged by the discounters in recent years, that's for sure. But the supermarkets are still where the vast majority of people go to shop each week, and if you want to be a mass market supplier, we need to be in supermarkets, and what we're finding is our brands very much are resonating with that supermarket consumer, and we've seen rapid growth over the last few years. That we see supermarkets as a share of our revenue continuing to increase. We think there's still plenty of gas in the tank in the UK. The acquisition of Salter brought a higher mix of supermarket business. But also, as we go into Europe, we're finding that we're not spending. In the UK, we started with discounts and migrated to supermarket. In Europe, we're finding we're going straight in at the supermarket level, rather than a discount. It seems to us that our offer in Europe is much more attuned to the supermarket rather than the discount segment. I mentioned online. About a third of our types of products are sold online in the UK, but we only sell 15%. So although we've seen strong growth in this area in the last few years, we've got plenty to go in the UK. And of course, online provides a relatively straightforward way to sell into international markets. And Europe has been growing rapidly for us. We're about to open a third-party warehouse in Netherlands, and this will give us more capability and open up many more opportunities over in Europe. When we say online, we mean via platforms. We do have some proprietary websites, but the vast bulk of our revenue from online comes from platforms like Amazon, like eBay, like dropship accounts with our retail customers. And then finally, and importantly, discounts. It's where we've come from. Discounts continues to be a very successful segment in retail overall. It continues to deliver growth for us, and we believe will do so for the foreseeable future. But we do see, we have seen our overall reliance on discounts reducing. When we IPO'd, it was above 60%. Now it's less than 40%, and we do see that maybe settling at about a third over the next couple of years. When we on the Capital Markets Day, we put this was back here earlier in the year. We put this slide up as kind of our, how do we see the future, particularly post pandemic. And I have to say, that was maybe 8-9 months ago. We did that Capital Markets Day, and it has so far stood the test of time. When we looked to the horizon, this is how we saw things, and indeed it's still how we see things. We do think, and I don't think this is particularly controversial, that people will spend more time in the home pre-COVID versus post-COVID versus pre-COVID. Even a modest increase in working from home actually equates to a big increase in the percentage of time that individuals spend home. So, if you go from 5 days a week in the office pre-COVID to 4 days post, then it's almost a 50% increase in the time that you spend at home, and that has got to be an opportunity for homeware brands like ours. We do say, partly as a result of that, cleaning and hygiene will remain a high priority. If you're in the home more often, you have to clean it more. But also we've had this kind of driven through us by everyone from the Prime Minister downwards, and we do think some of those habits are going to stick post-COVID, and that's an opportunity for Beldray and for Clean Easy. Again, linked to the more time in the home points, home cooking is here to stay. We're going to be at home more often. We're going to be cooking at home more often. But we also think home entertainment has gone through a step change. I think people have discovered how to cook more dishes. They've discovered maybe where to find a better bottle of wine. And people have enjoyed home entertaining, and we do think that's here to stay. And that's an opportunity for Salter, Russell Hobbs, Progress, and indeed Petra. I've mentioned online. It is structural. Although things are settled now that that retailers reopened, online is operating at about a third higher than pre-COVID times. So we want to take our revenue share of online to about 30% of our overall turnover. Expenditure, we believe, will be more considered. We believe that during lockdown, people have learned to save, and at the moment, the evidence is that they're not just now that things have reopened. People are trying to hold on to those savings. Okay, they're getting out and maybe they're deploying money, but in the main, they're looking to keep hold of some of that, and they're looking to not to lose those saving habits going forward. I think in addition, now we can all see that next year, with tax increases and inflation and things like withdrawal of universal credit, you know, things will be tighter next year for the consumer, and we believe for everyone, but we do think this is better for brands like ours that deliver value. We are seeing also that retailers will favour reliable suppliers. In fact, it's not a will, it's an is. You know, this supply chain crisis has really opened everyone's eyes to the importance of having a resilient and robust supply chain. And whereas pre-COVID it was predominantly about price, and price will always be the number one factor in a buying decision. What we are finding is reliability is of a higher priority than it was before. It's no good getting the best price if the product doesn't get on the shelf, and we've always had an exceptional reputation for delivery. We're finding now that's really delivering a huge commercial advantage. COVID has led to retail insolvencies, quite a few, particularly earlier on in the crisis, but virtually none of those were our customers. You know, our focus on the 4 pillars, they are the winners of retail, and that has proven to be the case. And then finally, Brexit. You know, I mean, regardless of what people's views might be on the merits of Brexit, it certainly has introduced more complexity into how we trade with Europe. And you know, we are a business that is really good at complexity. You know, we supply over 300 retailers each year, all of whom have their own ways of being supplied. So we're used to managing complexity. So I think it puts us in a good position to manage those challenges. Okay, in the annual report, we issued an in-line with expectations outlook. I think this was given the well-publicized supply chain challenges. I think this was well received. But you know, the reality is that you know, this is without question the toughest operating environment the business has ever experienced, and is the toughest operating environment by quite some margin that we've ever experienced. So it's very tough. There are substantial day-to-day challenges. But we see that as an opportunity. This is our opportunity to shine, and I'll probably have less grey hairs when it passes, sorry, more grey hairs by the time it passes. But at the same time, it is an opportunity to perform better than our competition, and I think so far we're doing that very well. Obvious questions are, you know, we perhaps have a higher level of confidence in our margin than others. You know, we've all seen some of those downgrades and warnings that people have issued around input costs. Now we have those same headwinds: factory gate inflation, huge increase in shipping costs, and also other supply chain challenges like you know, heavy goods vehicles and haulage have been very difficult. And so it's not that we aren't seeing those things; we definitely are. But we believe that we are managing them well. Plus, also we do have certain advantages in our business model which are helpful. So let me just talk you through those. First of all, we have passed on price increases. You know, we never like to do it because we worry about the impact on volume. But you know, we've had no choice at times, and although you can never pass it all through, it has partially mitigated those increased input costs. Secondly, which some of you will, but some of you might not be aware of, we do. About 40 to 45% of our business is supplied FOB or free on board. That means we hand the goods over in the Far East, and our retailer ships that product to the UK or to Europe or whatever. And so what that means is about 40 to 45% of our revenue doesn't track the shipping costs. You know, that someone else is shipping that product. So again, it's a really useful partial mitigation of of those increased input costs. Currency, we're operating at a better currency rate, a better dollar rate than we were 12 months ago, probably about 10 cents better. And that's a substantial help. Again, it's a partial mitigator, but it's certainly significant and very helpful. In terms of our margin in the medium to long term, and indeed to some extent in the short term, innovation is key. We bring about 1,000 products to market each year, roughly on a 3-year cycle. And when you bring a new product to market, it's an opportunity to reset your margin, bring additional value, additional features, maybe a change in design, and that's your opportunity to reset your margin and go again. And that's helped. We continue to develop product during all the lockdowns, helped by the fact we've got a fantastic Guangzhou office, so we have boots on the ground in China, despite the fact we haven't been able to travel. And that continued innovation has really helped manage our margin and mitigate these cost pressures as well. And then finally, I would say, and this is always the most intangible, difficult to explain, we trade. We are from a trading, although we're a branded consumer goods business, our heritage is in trading, and that's always a difficult one to evidence on a call like this, but getting the best day-to-day out of every situation, getting the best outcome possible, and we've certainly traded very hard over the last 18 months. For example, we've traded our stock very hard. Stock's been has been fairly scarce around the market generally. So, we've really worked the stock we've got to make sure we got the best outcome in terms of revenue and margin. So why might someone invest in us? Well, I have 9% of the equity, and management as a whole has, I think, 45%. These are our 4 reasons, and they may resonate with you. We are a business that has, we're targeting 500 million consumers across UK and Europe. That gives us, growth for the foreseeable future. So and then beyond that, there's the rest of the world. So, we are a business that has substantial potential for future growth. But at the same time, because we're capital light, we can pay an income along the way, and we just do distribute half of our profit after tax as a dividend. And we do have I think a reasonable dividend yield, which we know is often attractive to retail investors. Number 3, I think the last 18 months we've certainly proved this. The downside protection we feel in terms of the investor proposition is very strong. We are a business that can adapt very quickly to external challenge. And when circumstances change, we can adapt very quickly to that, as we've shown over the last 18 months. And indeed, many times over the years, our commercial teams are fantastic at being able to, sort of change their focus and respond very quickly when there are challenges to deal with. And then finally, community. I would ask you all to read our ESG reports. All of these things at the moment are work in progress, of course. But I think for small cap, we punch very much above our weight. We did a lot for the community, we believe, over the last 18 months. We're based in Oldham. Oldham is by some measures the most deprived town in England. And if you go to our LinkedIn page, you'll see our sort of journal of the things that we did. And I've been surprised. Well, I suppose it shouldn't be really, but I've been. It's been great to see the response of investors to the things that we did. We repaid the furlough, we helped our local community, and the next step for now is environmental. And we do have some. As I say, if you read our ESG report, we do have some good plans there to reduce and eventually eliminate our impact on the environment. Okay, well, I'll hand back because that's the presentation, and over back to you, Mark, for Q&A.
But if you do want to ask questions, click the Q&A button at the bottom of your screen and you can type your question into the box there. So we'll get going on the questions. Top of the list, Stephen asks, what extra sales and margin do you envisage with Salter now it's in-house as opposed to when it was licensed?
So I think if we go back to first principles, the reason we've grown our kitchen electrical and cookware business under the Salter brands from zero to kind of if you look at last year, £28 million. So we were very keen really to secure ongoing growth of those two product categories under that brand, and that was our starting point when we wanted to acquire that brand. We had a license that ran to 2024. We were confident of renewal, but you can never be 100% sure. So we've delivered fantastic growth over a decade. We wanted that to continue going forward. Scales is in the UK is pretty mature, and Salter has a decent market share already. So that when we initially looked at was not a key driver. The key driver was to get the brand so we can continue to grow small domestic appliances and kitchen electrical and cookware, and that continues to be the primary motivator for that transaction. However, I think when we step back and look at the brand as a whole, including Scales, Salter is the UK's oldest housewares brand. It dates back to 1760. It predates the United States of America. So we have, I think, certainly in the medium term, a great story to tell internationally, because Salter is almost wholly sold within the UK, both on the Scale side and indeed on the cookware and kitchen electrical side. So I do think that I am very excited about the international opportunity on what is the UK's oldest housewares brand.
Thanks, Andrew. Okay, then Stephen asks, have you considered moving manufacturing away from China for existing or new product lines?
Yeah, I mean, I think when you look at our business, it's very well diversified generally. In terms of customers and revenue streams, and even if you look at, we have over 200 factories that supply us, and none of those are more than maybe 3 or 4%. But where we do have a concentration risk is with regard to the territory. China is 85% to 90% of our product is manufactured in China, and of course, there are certain risks there, maybe there'll be a trade war, for example, between the US and China. So we are very conscious of that, and we are making efforts really to diversify that. But I think we've all, at the same time, got to be pretty realistic. I mean, the Chinese are very good at manufacturing this type of product, and forget about UP. If you go into your kitchen or around the house, the vast majority of these products, under whatever brands you own them, will have been manufactured in China. So it's going to be a long-term project to diversify away from China, but one that we are very committed to. We do already have manufacturing, for example, in India and in Eastern Europe, it is a high priority to the management team to see if we can expand that over the next few years.
Thanks. Okay, so I'll move on to some other questions that I had. So as you've mentioned in the presentation, you're having to deal with the supply chain challenges that every supplier is facing at the moment. I just wonder if you can add a little colour to how that's affecting you day to day, what measures you're having to take to try and deal with that. Beyond, you know, there's several points you mentioned in the presentation, but I'm still finding it a little hard to understand, as you say, how the grey hairs that you're developing, what's triggering them, what you're having to do to cope with this. It's hard to imagine what it's like.
So let's go back to the beginning, which is, you know, our manufacturers. So when we emerged out of COVID, they saw an explosion in demand. So of catch-up demand, really, because for quite a period, people, you know, retailers weren't ordering. So, you know, manufacturers went from being incredibly quiet to being incredibly busy in a very short period of time. And that had an adverse impact on things like lead times. To some extent, if you manage it carefully, it could have an impact on quality, because when manufacturers are very busy, they can be sometimes motivated to cut corners. So straight away we've had that to manage, and the way we've been able to manage that effectively is we've got boots on the ground in China via our Guangzhou office. You know, we have about 40 odd people based out of there with 15 to 20 on the road in the provinces, going into our manufacturers on a weekly basis. So. And we've been able to leverage relationships as well, because, you know, if there's a queue, you want to get yourself, it doesn't really matter how long the queue is if you're at the front of it. And that's been our challenge to our Guangzhou colleagues, is to leverage those relationships to make sure that if factories are busy, that they're manufacturing our product first. There are some signs of that easing up, and I think order books in China are definitely softening. So going forward, I think we should see that improve. Obviously, a side effect of that was pricing. When manufacturers are busy, they have more pricing leverage. But again, negotiation, relationships, having people locally, you know, speaking the same language, culturally attuned, you know, has been really helpful. Shipping, you have to see shipping as two issues over the last 9 months. It's about price. So a 40-foot container 12 months ago would have cost us $1,500 port to port. Where, you know, it can cost as much as $18,000 at the moment. We're averaging probably about $8,000. So we're doing better than most, but it's still a big increase on $1,500 12 months ago. So our you know, but really the second element of that is availability. So sometimes, even if you're willing to pay $18,000, it doesn't get you on the boat. And so there's been a sort of a constraint on capacity. It's been a price and a capacity challenge, and hence the issue with online in the second half and having less availability. So you know, again, you know, we've got, you know, long-standing relationships with certain forwarders, and that has stood us in good stead. And as I said before, we prioritized our retailers because we made commitments to them. So when space became available, we gave that to them. And then you know, it's getting product from the port to our warehouse, really difficult. You know, HGV issues all over the place, but the HGV issues are particularly acute when it comes to collecting containers from the port. If you think about it, Mark, if you're a HGV driver, you know, do you want to drive all the way down to Felixstowe, which is in the middle of nowhere, and sit outside the gates for 3 or 4 hours waiting to collect a container to bring it back to the northwest of England? Or do you want to do kind of 5 trips between a Tesco DC and you know, and their store? So that's been really tough. You know, we've put in place, and I've got to be quite careful here because some of this is commercially sensitive. We put in place really quite creative arrangements. You know, for example, you know, we've made our DC the most flexible DC possible in terms of intake. So, for example, if that container cannot be moved up on a Friday, but it can be moved up on a Saturday, then we'll make sure there's people there on a Saturday to tip that container. So I don't want to say too much because some of it is commercially sensitive, but we've been very, and I guess that's what you get with a relatively hands-on management team, you know, close to the coal face. So and then say again.
Sorry, you've really had to think on your feet and cope with things as they come at you.
Yeah, and you've got to be close to the action. You've got to be close to the action and see the issues, and try and come up with, you know, we've come up with some really creative solutions on the go of being apparent there. I'm definitely not going to share those with you because they that's real secret sauce stuff. Yeah. But you know, we have, but you know, it's been tough, and if you think about, say, our merchandising team, booking a container onto a ship used to be a tiny part of their job, and one that was largely procedural. Now they might, you know, in the last 6 months, that might be cancelled 4 or 5 times. They may have to rebook it, and all of a sudden it's a significant part of their workload. So it's been really tough on the guys, but everyone the resilience shown has been really quite admirable. I think, you know, the team has done a really exceptional job.
Yeah, I mean, we see that in the results. So thanks. I think that's really illuminating. Gives us a flavour of what's going on and how you're coping with it. The next thing I wanted to ask was how your margins vary by brand and by product category. Is it fairly even, or are there certain brands or product categories that yield rather better margins than others?
In terms of product categories, typically electrical items have a lower percentage margin. They're typically higher volume in terms of revenue, but lower percentage margin. And things which have a higher maybe design inputs, like cookware, tend to be the other way around.
Interesting.
And the brands then kind of follow that. Beldray, you know, is possibly typically lower because we do more things like electrical floor care under that brand. Salter's a bit of a balance because we do kitchen electrical under that brand, which would typically be a lower percentage margin, but we also do cookware, which is typically a bit of a higher margin.
Thanks. Yeah, that's interesting. Now with Petra, they're excuse me, traditionally known for their coffee makers. What sort of other products apart from the coffee makers do you expect to bring to market, if that's not too sensitive?
No, that's fine. No, and we're very close to relaunching Petra. We've got our range selected. We've refreshed the brand, and we're hoping to have a sort of large German retail partner on board in the not too distant future. But really I mean, anything kitchen electrical within reason, we can use the Petra brand for, and indeed the previous owners of the brand were doing that anyway. So all of the things that you might see under kitchen electrical for Progress or Salter, you might see those types of products under Petra.
So in those cases, would it just be a minor redesign of products that you're producing for other brands at the moment, or is it a completely new?
It's new products. The product itself is new. Obviously, if we bring I don't know, to choose simple, like a kettle and toaster range for Petra. This is new product, albeit the type of product is also, you also see elsewhere in our brands.
Right, so it's not just a case of slapping a different label on.
No. And that mark can be a misconception that we come across with some investors. I understand why they might have it. We are not. There's a pool of product and we just slap different brands on it. Each brand has its own personality and it has its own range of product that's developed separately, albeit maybe with the same manufacturing partners. So we get some, operational leverage benefits that way.
Well, that's where your talent pool comes in designing new variants of products that, as you say, fit the personality of the particular brand that they're designing for.
Yeah, definitely.
Good stuff. And then finally, unless anyone else has any questions, on the ESG front, one of the challenges is recycling electrical products when they reach end of life.
Yeah.
Do you do anything in that area at the moment? Do you have any plans to do more?
Yeah, I mean, we've been signed up to the WE scheme for probably the best part of a decade, where effectively we pay up front for our products to be recycled when they're disposed of. So that's been the case for quite some time. We've gone into really our ESG report this year with regard to environmental is more of an introduction. I mean, we're going to be, as we move through the gears in, during FY22 and 23 and beyond, we're going to get much more specific about the actions that we're undertaking to reduce our impact on the environment. Just some headlines. We have introduced a plant a tree initiative with some of our brands. So if you buy the product, we'll plant a tree. We do take quite significant steps to reduce, to reduce the plastic packaging, to have more FSC standard packaging that we're using. So we're going to be taking steps to carbon offset our shipping, because at the moment, obviously carbon offsetting is a second best to reducing your carbon emissions, but at the moment with global shipping there is no alternative. So we are doing a number of things, and I say I would ask people to read the ESG report to get a flavour of that. But as we move through as we move through FY22 and we issue the FY22 annual report next year, you'll see more tangible actions and targets set out. We do have an environmental committee. One of the great things about having all these great, talented and energetic youngsters is environmental matters are very high on the list of priorities. So when we asked for volunteers for our environmental committee, it was, we had many enthusiastic volunteers. And that's brilliant because they bring the ideas to management. They bring that energy, and that's been great, and that's going to be a huge source of inspiration really as to how we can improve our environmental impact.
Very good. And I just remind delegates that you've just published your annual report today, so you can download it from UPGS's website now, as I've done this afternoon, and read the ESG report as Andrew suggests. Super. There's one more question now coming from Stephen. He remarks that the USA has very low revenue at the moment. Is this a growth area? I presume the revenue at the moment is from online sales currently. Is that correct?
No, we do. We have some business with TJX, TK Maxx's parent company. Mm-hmm. So obviously we trade them with the UK and we trade with them in the US as well. I think when we first thought about international, we did kind of think the more, should we say, Anglophile countries would be the more obvious place to go. But in reality, we found that was kind of trumped by geography, and so we have learned the lesson as a management team to not go too broad too quickly. Otherwise you can lose focus. So we are very much focused in the medium term on Western Europe. But Stephen is right. Our products and our brands, I think, in the long term would resonate in territories like the US. British heritage brands. You do feel intuitively there is a place for them in that kind of market. Plus also markets like, say, India, perhaps.
Mhm.
Australia is actually developing into a really nice market for us anyway. So we might see that kind of, we might talk about that more in future presentations. We do have a distributor over there that we've appointed recently who does seem to be performing very well with our brands. And I mean, you never know, in the long run, possibly even China itself might prove a decent market. So, you know, but you know, for the moment, our focus as a management team is on kind of those large consumer economies in Europe as well as the UK.
Yeah, there's plenty to go for there, and then you can broaden out once you've conquered those markets fully. So lots of room for growth in the future, which as investors we rather like to hear.
Well, exactly. I mean, I like to go back to what I said earlier on the presentation. You know, you find our products on countertops all over the world. Mm-hmm. So the total scale, you know, the total scale of the opportunity is truly global.
Excellent. Well, I think that just about wraps it up. So thanks very much, Andrew. It's been great chatting with you once again, and thanks for a super presentation.
Thank you, and thanks everyone for your time.